I'm filming this video Monday morning, April the 7th, before the market opens. Last week we saw a lot of volatility. What should we expect in the markets this week? Are we going to have a Monday morning meltdown or a Monday morning melt up? What should we expect later in the week, and what sectors might perform well? If we take a look at the markets last week, we saw the S&P 500 down 9.6%, almost 10%. The defensive sectors all outperformed the market, although they were negative. The big loser of the week was the energy sector, almost down 16%. We're seeing Trump focus on lowering energy costs, and then we saw OPEC come out and announce that they were now shifting forward more production as well, which affected the energy markets. If we take a look at some of the markets around the world, here we can see the TSX Composite was down 6.9%, down a lot, but not as much as the S&P 500. And that's been the trend recently in Europe as well, approximately the same as the TSX last week. China was actually quite decent, still negative, and emerging markets as well. So we've seen most markets around the world outperforming the S&P 500 as investors are looking for alternative places to invest. If we look at some selected sectors and others, we can see gold was down 2.7% last week. That's not a lot, and that was really mainly the reaction on Friday. So gold's actually been holding up quite well. Gold miners down approximately the market. Silver more than the market, along with the metals and mining as well. Semiconductors, as you would expect with weak technology. Home builders, look at home builders. It was only down 4.2%. That's because interest rates moved lower and investors are still doing the knee-jerk reaction to lower interest rates, saying that that's going to help the home builder sector rather than focusing on, are we moving into a weakening economy? So we're seeing investors still really invested in this market, even though we are seeing that shift towards the defensive sectors. Last week, we saw the yield on the 10-year Treasury note close down for the week at 3.99%. If we take a look here at the U.S. dollar, this is CAD US dollar here, we can see that the Canadian dollar actually went up and closed at 70.3 cents. That's unusual to see the Canadian dollar do well in a risk-off environment versus the U.S. dollar. In fact, the U.S. dollar actually went down last week relative to world currencies and closed at 103. There's something strange going on with the U.S. dollar. I'm going to talk a little bit about that because usually in a risk-off environment, the U.S. dollar rises. On Sunday night, we saw a lot of volatility as the futures opened up around 6 o'clock Eastern Standard Time. And then we saw, if you take a look here at the federal funds rate expectations for cuts, right here actually, 4 cuts were expected in 2025. Investors really shifted. We saw futures down almost 4% or over 4% for the S&P 500. Investors started to say, well, we expect the Federal Reserve to start cutting more. And then half an hour later, the cuts expected for 2025 went to 5. So we're seeing some real negative pressure in the markets, pre-market on Sunday night and as well on Monday morning. If we take a look at the S&P 500 here, we've got the orange line being the 200-day moving average. We did cross below the 200-day moving average earlier this year, took a run back up to it, went up a little bit above it, and has come back down again. As Paul Tudor Jones says, nothing good happens below the 200-day moving average. And we are starting to see the 50-day moving average come close to crossing below the 200-day moving average, which investors refer to as a death cross. I don't read too much into it, but you'll start to see that in the news as well. Here we are closed last week at 5074, and if we get to 4915, that means that the S&P 500 will have dropped 20% since its February 9th high. That would be bear market territory, so we'd expect to see some buyers probably step in at that point, buy the dip buyers. This is an interesting graph here. If we take a look at investors in the NASDAQ versus the S&P 500, the blue line is the S&P 500. This is shares outstanding. We can see that it's gone down. So there's been more sellers than buyers. But look what's happened in the retail sector and for the retail investors. Particularly, we're seeing the NASDAQ, the number of shares outstanding really hasn't changed that much. So there's still some interest in the technology and growth part of the markets. This is a key graph. This is the dollar versus world currencies. The orange line here represents the trend for the US dollar relative to world currencies in 2016 and 2017. And you can see for the election, we saw the dollar rise higher into 2017, then go down. It actually went lower for quite some time. And this blue line represents what's happening now in 2024 and 2025. We saw that peak in early 2025, and we've seen the US dollar head lower. We saw that little tick higher on Friday, but we are seeing that trend lower for the U.S. dollar. Trump would like a lower U.S. dollar with falling interest rates. That's putting downward pressure on the U.S. dollar at this time. To put it in perspective, here's the US dollar over the last few years. You can see that it really has had a consolidation taking place here over the last few years. It did go above that box after the election and it's come back down. It's really come close to the bottom of the box here. If we take a look, here's where the US dollar touched 100 here relative to world currencies, almost 100. And here's 100. That's the key level to watch. If we see the US dollar break below that, that could be concerning in this rally. But investors are really focused on other investments around the world. They're looking at the U.S. and saying, well, we're seeing cutbacks from the government. We're seeing tariffs really could have an impact on the U.S. as well. So they're looking to pull back their money and invest in other countries, other sectors outside of the U.S., and that's having an impact on the U.S. dollar. If we take a look at the VIX last week, the VIX typically when it reaches 40, that means it's, investors will look at that as a buy signal. 35 has actually been over the last few years some of the key levels here where we've seen 35, and that's actually represented some good times to buy in the market here. And we can see it did touch 40 at this level here. Last week it closed at 45. So typically investors will often look at this level and go, this is the time to be stepping into the market, but it doesn't have to be. The VIX can move higher, of course. Here's the yield on the 10-year Treasury note. We can see here that really over the last few years, it has been in this consolidation range. It's heading back down lower, but we're still above the level that it was back in September of 2024. That wasn't that long ago, so we could see the yield on the 10-year Treasury note close lower. And if we do see some real concerns about the inflation, expect it to drop below this consolidation. Here's an interesting graph to show you what investors are doing. They're still interested in being invested in the marketplace. They're not necessarily moving to cash, but here are the defensive sectors relative to the S&P 500. When the line's rising, they're outperforming. Here's utilities in 2025. This is consumer staples, and this is healthcare. All three of these sectors have been strongly outperforming the S&P 500. We are starting to see the credit spreads actually move higher. They're still really low at this point compared to historical norms in this particular situation. So we haven't seen a capitulation taking place, but it's something to keep an eye on. The line represents the federal funds rate. The yellow line represents the yield on the 2-year Treasury note. The 2-year Treasury note usually leads the Federal Reserve. Some investors say the Federal Reserve shouldn't exist. We'll just use the 2-year Treasury note. And if you take a look here, the 2-year Treasury note is lower than the federal funds rate and moving lower, which indicates that it's putting pressure on the Federal Reserve to start cutting rates soon. Last week, we saw JP Morgan come out with a change to its outlook. We saw that it now expects GDP to move down into negative territory for 2025. That's not good news. JP Morgan also expects the Federal Reserve, or says that the Federal Reserve may start to cut rates before the next meeting. I think that's a little bit of a panic. I don't think that will happen. It would be strange if it did, but it just shows a sentiment shift that's taking place. The tariffs in the first round in February and then into March are very different than what's going on right now. So on Friday, we did see China come out with its counter tariffs, which really pushed the market lower on Friday. But on the weekend, we saw the White House announce that more than 50 countries have announced that they want to actually negotiate with the U.S. around tariffs. And we saw Trump come out and say that he's open to negotiations. And this is a new movement that's taken place. Almost all the countries around the world have said, okay, we're not going to do counter tariffs back to you. We're not going to try to inflict as much pain as possible. We're just going to hold where we are right now, and we're going to negotiate. We could put tariffs on later if we have to, but let's be diplomatic about this. Let's be mature. So we've seen this real shift taking place. There's very few countries that are putting counter tariffs back onto the U.S. at this point. So it's probably the better way to go because you can still put the counter tariffs on back later rather than have this big, huge war. We really need to see cooler heads prevail at this point. This week is a busy week. We've got a Federal Reserve minutes coming out on Wednesday, CPI inflation on Thursday, jobless claims on Thursday, PPI on Friday, and consumer sentiment on Friday. And then what do we have on Friday? I think is going to be a big event. We have the earnings season being unofficially kicked off on Friday with the banks in the U.S. announcing. We've got JP Morgan, BlackRock, Wells Fargo, BNY, Morgan Stanley all coming out with earnings. Now, the preferable situation is to see the banks come out with strong earnings and good guidance. That really helps to provide legs to the market. The banks are part of that core engine for the economy to move higher. So we would really like to see that. So I think this could be an inflection point for the market. If we take a look at what happened last week, we saw the self-proclaimed Liberation Day on Wednesday. Then the market reacted negatively on Thursday, and then Friday it was negative, and then China announced counter tariffs, which really pushed the market down. And the futures are indicating that we could see a negative day on Monday as well. However, I do want to say that when you see big events take place in either direction, it usually takes a few days for it to really absorb, particularly on the downside. So it's 3 or 4 days, and then we start to see some stability taking place. So if we don't see any new announcements around the tariffs, we could start to see some stability in the markets. In other words, the markets have digested this news. Given that the negotiations are different than what we've seen in the previous iterations of the whole tariff war, if you want to call it that, we're probably going to have a few weeks here where Trump, negotiates with countries and makes a package announcements and say, okay, these countries we've negotiated the tariffs and changes are taking place. So it's probably going to be put on hold. So I don't expect any fast resolutions like to come out and say that, we've negotiated these tariff packages really quickly the next day and the market's going to respond positively to that. So I think we're going to be sort of on pause for that at some point. Still going to be some huge concerns about what the tariffs could do for the economy overall. But we'll probably also see the market gain some stability later in the week heading into the earnings on Friday for the banks. And really like to see the banks come out with the strong earnings. What's going to be really important here is watching the reaction of investors to the bank earnings. And I think that we're going to get a direction confirmed either up or down on Friday. So we'll have to wait and see. Thank you.